friends. Welcome to the Skinny on Wall Street with us, the Wall Street Skinny. I'm Kristen.
I'm Jen.
And so I know we've been a little bit MIA, sort of. I mean, not really, because we've been putting out basically like a totally new podcast series, but we skipped a couple weeks for the Skinny On. I promise we will be back in full swing. But we are just basically working around the clock trying to get this course past the finish line. We're really excited about it. It's going to be awesome. It's just become all consuming. So
to give you guys a sense,
mm-hmm.
Kristen's not exaggerating here. I don't think she's slept more than 5 hours in the past few weeks. I joined her last night for some of the effort. Fun fact, I was wearing this dress yesterday.
Yeah.
I literally slept in my clothes.
Well, I was going to say, I mean, I think that what's really fun about this and exciting is that we're doing something that's totally different from what's out there. And what we're doing is we're basically making sure it's actually us talking to you. We have graphics for every single thing that we're doing. The timing of every single word that's coming on the screen has to be perfect. We've hired like actual professional editors to help us make this. And so it's been this whole process where there's also the little bit of, investment banker perfectionist in us. So we had our editors promise they were going to get us stuff by a certain date. And then we looked at it, we're like, well, this is not aligned. Like this is, and so I feel like we are the clients from hell. But
There's
I promise you guys,
please fix energy.
Yes. But I promise you guys, it is going to be super awesome when it comes. It's just unfortunately taking a teeny bit longer because, like I said, you have two type A perfectionists who are micromanaging every single, comma, period. Like literally, I was that person who was like, there are periods on these bullets. Like there should not be periods. And again, that when I was in banking would I'd be like, are you kidding me? Are we really talking about a period? And now it's like, nope, we're talking about a period. So anyway.
For those of you who don't know, the actual course that's coming out is it's like our flagship everything course for the fundamentals of investment banking and private equity. So this is Kristen's masterpiece. This is 100% her voice, her wheelhouse. And you're getting not only the benefit of her experience teaching, her experience working on Wall Street, you're also getting the connections that we have to all of the senior thought leaders within the industry from the top, and all of the conversations that we're having on an ongoing basis with those of you who are entering into the industry. Yeah. This isn't like, oh, what did the Vault Guide say the questions were in 2005? This is real questions that you guys are getting asked on an ongoing basis that we've compiled from talking to quite literally thousands of incoming candidates, and also live like they're dead, but current analysts and associates in the seat, because the roles are changing on a day-to-day basis. Yes, obviously everyone needs to know how to build a discounted cash flow model, but how you're getting asked to demonstrate that skill has really shifted from when we first broke into the industry. So I think what's so special about what Kristen has built here is it is like a living document, right? That is so reflective of all of that knowledge.
Yeah. And I mean, and also for both of us, I mean, like there's so much stuff that, 2 years ago when I was teaching stuff, there were things that I had like missing knowledge, understanding of just the way that the broader world of Wall Street works. And so we're putting together, again, it's like the world of Wall Street is one of the bonus modules where we're literally breaking down all the various players, how they interact with each other, how it all works. And I think it's actually really fun because it's it's sort of taking all this stuff and like putting it into, again, like this like child, although we literally wanted it to be available by now. And as Jen was saying yesterday, she's like, you're basically like, you had a due date. And for anyone who's been pregnant, it's like, now you're overdue and you're just like, this needs to be in the universe. But it's just, again, it's been all consuming, but it's really fun. We're really excited about it. The quality is amazing. And actually, the other thing I do want to add is obviously having spent so long working and teaching this stuff, that's great. But I also think having Jen as someone who's like actively learning some of these things, being able to give feedback of like, you say this, but like, I need you to give me a little more. Like, I don't understand this. Yeah. Well, because again, I do think that sometimes even for someone like me, who is very focused on explaining things, having her voice being like, I am the stand-in for someone just learning this and I don't get that. So I feel like you're just getting the benefit of so much and we're super excited about it. But yeah, like I said, all consuming. With that out of the way, there's a couple of things that we wanted to get into. So okay, hold on. What were we talking about? So we were talking about the course. All right.
We get distracted every time we talk about the baby.
I know. All right. So what we wanted to do though is, again, because we obviously have not been on, we wanted to talk just about a couple things that have been going on in the markets and some interesting stories. And so first of all, I guess it was a couple days ago. So October 1st, I think it was Apollo's Investor Day. And there was, a number of stories that came out from that. So like the sort of world of finance, like I feel like everyone is talking about private credit. And so one of the things that they had said is that they were looking to double their assets under management. So for those of you who don't know, Apollo has basically assets under management, aka AUM, of $700 billion across a number of investing strategy. Like, yes, their bread and butter, they got started with private equity, but like now they do a whole bunch of other stuff. And so one of the areas that they're trying to get into is private credit, which is like the darling of everybody. So they are saying now they want to basically go from $700 billion to double that. So what, like 1.4 trillion. Yeah. In the next 5 years. And for context, other mega funds out there, so KKR has about 500 billion, Blackstone is about 1 trillion. And what's also interesting is when they were talking about this, they announced how, they were like, basically Wall Street banks are dead. But meanwhile, JPMorgan is trying to, quote unquote, get into private credit and has partnered with a number of different partners. So Cliffwater, FS Investments, Schenkman Capital Management. I don't know how to pronounce that.
If you can't beat them, join them.
Yeah. In an effort to reach this 1.7 trillion AUM. So the other thing that I thought was so interesting and was kind of funny is last year, Apollo and Blackstone put out these hilarious Christmas videos that were clearly targeted at more of like the younger generation, Gen Z. And I think part of it, when we were talking to Jennifer Prosek, one of our other favorite episodes, if you haven't listened to that, How to Network Like a Pro, she's amazing. But she was talking about how her job, she gets hired by all these different asset managers to help with their branding, help with their, not public relations, that's the wrong word, but basically like their story and help them sell, how they want to present to the world. And one of the things that she said that was interesting, she was like, I think part of that was actually almost a push into the retail client. So as they're trying to, again, amass this empire of like fees, they're trying to also reach the individuals like us. It's not just the institutional investors, the pension funds, the endowments. It's also individuals. And so part of it felt like they're, again, leaning into that. And then also at this investor day, they like were using memes, and which again, to me almost has this rhymes with kind of what you see Kamala doing, where she's like leaning into like the TikTokization or whatever, like the TikTok world. And it kind of seems like they're doing the same thing. So anyway, just kind of really
Are you trying to say that Apollo should partner with the Wall Street Skinny on some real content?
Maybe.
Do you think they'd like to be in my next music video? Really quickly, before we get into some of the meat and potatoes of this, we're going to be attending the Capital Integration Systems, or the CAIS conference. And what they do is they help all the advisors and the allocators basically pair up with and connect with a lot of these big institutions. We're going to bring someone on who's actually a representative from that organization. And so I think it's really interesting, Kristen, too, because I also wonder to what extent that effort to branch out into the quote unquote retail market. I don't know about you, but if that's on my radar as a retail investor, right? I also wonder to what extent it's on the radar of private wealth managers who are also trying to, you know what I'm saying, get in front of a lot of these funds and get access to. It's telling a little bit of the story about what the fund is, other than we're just super big and bad and we are making all this money and like you should be so lucky to invest with us. I think they're actively now courting that, and the tables have turned a little bit, whereas it used to be the private wealth management advisors being like, please, can we invest in you? And they're like, what's your money?
Yeah. Well, it's interesting because again, with this meme that they had, it was like the industry, and then it was sort of like, everything that the industry is able to generate is beta, whereas Apollo, it's like it's all alpha, and it's all the operational improvements. And then they had this other one, which was like, it's not just a decade of low interest rates and high leverage. You added real operational value to your portfolio. And it's this guy like pointing in a mirror. Anyway, it was kind of funny. But then speaking of just like, obviously Apollo is, again, huge in the space. On the other side of the spectrum, so we have Apollo as like the private equity giants. On the other side of the spectrum, recently the news this last week was about Millennium. So Millennium is a massive hedge fund. And Jen, I'll let you talk a little bit about it. Fun fact also, if you're not getting our newsletter, we put that out today. Jen had an amazing explanation of what we're going to talk about. But again, if you are someone who likes to read things and see visual pictures and stuff, definitely get on the newsletter.
You can listen to the newsletter too.
This is true.
Some chick named Jessica. I don't know who that bitch is, but she reads our newsletter out loud.
I know.
She's great. She's like a Siri type voice.
Someone thought it was us reading it. And I was like, they were like, did you AI your voice? And we were like, no, it's a random other AI voice, but it's not us.
This is the AI version of a generic white woman. So there you go.
Yes.
But no, well, the story about Millennium was in the Wall Street Journal. Quite frankly, it was a bit of a puff piece. It was about, Millennium has something on the order of magnitude of $69 billion in assets under management. I used to cover some arms of Millennium when I was on the rates desk. And they're a great fund. They've had an awesome track record. I think they've only had one down year ever, and that was 2008. And I feel like 2008 is like, oh, well, like you got to pass on that. Everyone was down 2008. Like that was a rough time.
Yes.
But what they were attributing that to in large part was their very tight stop losses that they have. And stop losses is just another word for risk limits. And so what that means, the article gave some examples that are kind of top of mind for me. So I'm not quoting directly from the article here, but just fresh in my memory is that if a portfolio manager is given $1 billion worth of capital, if they lose $50 million, they get a tap on the shoulder. And it's, hey, listen, things are not going well, okay? They might cut that portfolio manager's capital allocation by 50%. And if they were to lose an additional 25 million, they might get fired altogether. Now, obviously there's some exceptions to that, but to put that in the scope of like normal people like you and me, because once you say billion, like people everyone's like, billion this, $1 trillion that. Okay, let's say you made $1,000 investment and you lost $75. That's like kind of a crappy month in the markets, but like, really, is that so much skin off your back? It's not the end of the world, okay? That's it. You're out of a job. So like, that's a very, very, very tight stop loss, especially considering how much leverage specifically in the fixed income portfolios of these firms you need to run in order to return on that fund. Right? So we've talked before about how leverage works in the fixed income markets. Even if you've got $69 billion in assets under management, when you are trading fixed income products, you are likely levering that up on the orders of magnitude of 20 to 1.
But also on top of that, what's interesting is my understanding of how these pod shop works is like, let's say they get $100 from investors. They're also going to the bank and they're borrowing like whatever, 4 or 5 times, however much. And then they're taking like $500 and that's what they're giving to the portfolio managers. So they're already like levered up a shit ton of times. That's why they have such strict limits on how much they can lose and everything. But it's wild. And one of the things that in the article they were talking about, it's like, if you go work for a Millennium or Citadel, not to basically get too comfortable and buy new furniture for your office, because you're trading at that shop until something goes wrong. And then you're out and then you're off to like Citadel. And then maybe you're at 0.72 and then maybe you're back at Millennium again. But like it's not the type of thing where you're just like sitting pretty and working there maybe if you're amazing, but like they kind of know. And there was actually last year, there was an article about some of these pay packages that they would give to really great portfolio managers of like, they were getting people to come over, giving them like $100 million which is wild. But again, it's the amount of stress that you are under. Like, I don't know. To me, it's too much. Like, I don't know. And actually, Ashish, again, this is one of our, I feel like I've said this like 5 times, like another plug for another episode. Like, I'm sorry. I really didn't mean to do this.
Another best episode ever. No,
yeah, another, actually,
really,
this one probably.
Good, whatever.
Yes. Yeah. No, so we had Ashish Goyal, who was a portfolio manager at Citadel, at Balyasny, and at Bluecrest. Oh, did I also mention he's blind? He's the world's first blind trader. Like also, just happened to be a FYI. His story is incredible. But he was talking about how in 2008, Warren Buffett had said something like, I'm bullish on the US economy. I'm buying America and you should too. And he was like, that's a cool sentiment. But like he said, if you were at a pod shop like this and you tried to put on the trade that Warren Buffett did, you'd be stopped out like 5 times in like the first 12 minutes of the trade. So it's really hard to be really successful at these funds, as I guess like the moral of the story.
That's exactly right.
So
one of the other concepts that the article got into was how you actually measure the effectiveness of those stop losses in terms of translating into then that P&L that they are delivering, that return that they're delivering to investors that allows them to justify the massive fees that they're charging. Yeah. And one of the metrics on which capital is allocated within these firms and the performance of those returns are then measured is something called the Sharpe ratio. And don't worry, this isn't Like, it's funny when you hear like, oh God, it's a finance person talking about a thing. Is this going to be Black-Scholes? Like, am I going to be in the weeds on some giant formula? Okay, I promise you, nothing more than basic arithmetic involved. All it is a measure of how much you return over the risk-free rate, right? So if your money was just parked in like the lowest common denominator, easiest thing that could never lose money, basically like an overnight money market fund, whatever you were able to return above that through your investments, let's say, again, for simplicity's sake, let's say that risk-free rate is 5% and you return 10%. Okay, your excess return is 5%. What's that over the volatility of the actual investment itself? So if you divide your 5% excess return by, say, 2% volatility, you look like a hero. If you divide that 5% excess return by a 20% volatility, you look like a moron. Because basically you were just clinging. It's like jumping on a mechanical bull and clinging on for dear life. Yeah. And Kristen, you've made the point very eloquently on here before, but I think it bears repeating that with hedge funds, you have the basic math of compounding, right? We've talked through this before, that if you have a hedge fund that's down 50% one year and then up 25% the next year, when you just read the headline, hedge fund up 25%, you're like, wow, they're heroes. And you're like, no, they still haven't even gotten back to flat, right? So
they would need to get 100%. Yeah. And I want to make that point. It's like, if you have a down year of 50%, to get back to where you started, you need to make 100% back. So this is, again, Paul Podolsky made this point in one of our very early episodes about the whole point with hedge funds. Seriously. Which is like, one of the key things is you want to limit the downside. And I do think, again, and I put a reel out on this, a couple weeks back, how when it comes to investing in equities, if you're like, sure, I want to like low fees, I just want to put my money in, never look at it again, I'm not going to need that money, I don't need to buy a house, I don't need to like get money out for retirement, I don't need college tuition, cool. Stick your money in whatever equities and like walk out. Again, American innovation or just innovation in general, like I think that's a great thing to do. But here's the thing, like equities are really fucking all over the place. Like they are really volatile. So you have like an amazing up year and the next year is amazing. It's like a terrible down year and then it's an up year. And so this is something that I actually experienced because this is like so sad. I had my money in cash for so long. And then in like 2022, I decided, you know what? This is so dumb. I'm putting my money in the markets. And then we needed to buy a house. So I had to liquidate, and I liquidated when the market was down, which is like, again, any financial advisor would tell you, if you think you need money in the short term, like you don't put it in these freaking highly volatile investments.
Well, you didn't think that you were going to need money in the near to immediate term because you thought you'd be in your existing home.
No, actually, no. Actually, this is the sad part, is that's not even true. I was still in a 2-bedroom with 3 children. No. I just was like actually a moron. I'm actually a moron. I'm very good at
the lesson there is invest early and often, and the riskier your investment, the longer your time horizon needs to be in order to offset that likely volatility in the underlying asset.
Yeah. And that's, again, the whole point with hedge funds is that they're delivering excess returns while having less volatility. And so that's ultimately with the Sharpe ratio. Right. Theoretically. But like, that's the whole point with the Sharpe ratio is you're getting these excess returns for lower volatility. And so that's what was the Sharpe ratio for Millennium?
So according to the article, it said that kind of the average bear in the hedge fund space that's a peer of Millennium's has a Sharpe ratio of something like 1.1. And again, 1, good, 2, better, 3, best, as we continue going, right? You want a higher Sharpe ratio given the math that I just walked you through. So it said that Millennium's Sharpe ratio was reported to be 2.6. So more than double kind of the average of its peers, thanks to those stop losses.
And just one more data point, I think the S&P Sharpe ratio is about 0.3. So just to give you guys a sense
over like a 60-year time horizon.
Yes, right? That's exactly true. Yeah, you have to include what the time horizon was. But I do think it's, again, just helpful as you're sort of thinking about, okay, Sharpe ratio, higher is better. Again, 1 is kind of what you see a lot of these hedge funds targeting. The equity markets is about 0.3. Millennium is closer to 3, which is, again, wild. But it's also... it sounds like it's a really tough place to work. So,
okay. So with that, I think that kind of wraps it up for this segment. Now we're going to bring on Alex Cavallari, who's director of marketing over at CAIS. Again, that's Capital Integration Systems, that is pairing those investment advisors with those big hedge funds, private equity firms, private credit firms. We're going to the CAIS Summit in just about 2 weeks. We're super excited. And Alex is going to come on, tell us all about what CAIS does and what the summit is and why we're so excited. So let's bring him on.
Awesome.
And so we've been talking about how various advisors and allocators approach their investments in the alts and in the private capital markets. And I think there's no one better to speak to the challenges being faced by these investment advisors than Alex Cavallari, who's the head of marketing at CAIS. And full disclosure, Kristen and I are so excited because in less than a month, we are going to Beverly Hills to attend the CAIS Summit, which I am so incredibly excited for. We are so honored to be able to have the opportunity to be even in the same room as some of the talent that's going to be there. So, Alex, can you please tell us a little bit about what CAIS is and how you're solving problems for investment advisors?
Yeah, so CAIS, the best way to describe CAIS as a platform is we are an end-to-end solution for financial advisors in the alternative space. Mm-hmm. So traditionally, financial advisors haven't necessarily had access to a lot of the products from institutional asset managers in the alts world, whether it's private debt, private equity, real estate, infrastructure, whatever the case may be. So CAIS built the platform, and we started back in 2009 to give advisors access to those institutional asset managers, every big asset manager that you can think of. And we built the platform as really an end-to-end solution. So everything from accessing or discovering product all the way through transacting that product and managing that product after the fact. So we think about it in kind of the pre-trade, trade, and post-trade experience where we're giving people access, we're allowing them to actually buy and manage those products. And then we're also integrating with all their reporting provider systems, their custodians, et cetera, across the board. We've been building since 2009, and we've built an incredible network of both wealth managers as well as asset managers who are coming together in this central place to do business together and interact and get educated with each other.
So, okay, trying to break this down for a layman like myself who isn't necessarily so well versed in this. I remember, God, Kristen, must have been like episode 30 something, ultra high net worth private wealth management. And we talked about the problems that so many private wealth management firms face in trying to get access to the best deals and get invested in the sexiest hedge funds or whatever it may be. So is what you're saying that, let's say we have a wealth manager like that, and they want to make $1 billion allocation to whatever it may be, let's say private equity, right? They can go into your platform and use that to buy into those funds and then manage their allocation that they have throughout the life of that investment. Is that how it works?
That's exactly how it works. So you think about a traditional wealth manager who may be either dipping their toe into alts or wanting to get more allocations from an alts perspective. Traditionally, they either had to go out and source their own deals, or they had to have a specific high enough client threshold to be able to have that conversation or do that type of business. We built the platform to enable them to get access to the top and leading asset managers across the board, and specifically enabling them to not only get access to those managers, but also manage those products and transact in those products across the board. I think one of the things that we saw specifically is we essentially put the alts product set on the digital rails. No one likes filling out a 60-page subdoc. No one likes filling out the paperwork. We digitize that entire process from start to finish, enabling them to essentially source and transact and monitor those products across the board.
And so really basic question here again, these asset managers and these advisors, oftentimes that's not their wheelhouse. Private capital markets and the alts may not necessarily be their bread and butter. For so many of them, especially with evolving sectors like private credit, where you ask 10 people what a definition is of private credit and you're going to get 10 different answers. How do you educate those investment advisors about what the opportunity set looks like, about the risk reward, and about how to differentiate between the different potential investments in the alt space?
Yeah, so education has been a core to CAIS ever since we launched the business. It's been a part of the DNA of the platform, a part of the DNA of what we do every day. So we educate in two core ways. The first of which is a digital orientation. So we have CAIS IQ, which is our leading educational platform. So essentially, we have courses on everything from private credit to private equity to real estate to venture capital, whatever it is. You can go in as an advisor and you can essentially take a course where you're getting educated on that asset class or you're getting educated on specific products on our platform. That's one way. The other way that we've really deployed is through in-person engagement. So we launched the series called CAIS Live, which essentially we have 15 events that we're doing throughout the country. And we're traveling to different major cities and we're educating advisors live. At the end of the day, this is a people business. People like to be educated live, and they like to get in a room with the asset managers. They like to get in a room with CAIS and have a conversation around these products. And that's really how we're blending both online and offline together, is educating them from the CAIS IQ side on the course perspective, and also doing things like webinars, in white papers and thought leadership on specific topics, but then really bringing this offline element, which launching CAIS Live, and then also blending into our CAIS Summit, which this will be our third year in a row doing it, and getting the right folks in a room together to have the right conversation has been a key pillar of our ecosystem, because essentially what you see is you see advisors who may at the very beginning of their journey, and they're really about the why. Why should I think about alts as it relates to my book? Yeah. Why should I think about alts as it relates to my client portfolios? And then you kind of look at someone who's been adopting alts for years, and now it's more about the how. So it's essentially, how does this fit in? What is this replacing? What is this supplementing in the portfolio? And we want to make sure that we have solutions for each side of that spectrum. Either it's someone who's early on or someone who's further along, and they can come to CAIS for everything, no matter where they are in that journey. And that's been our focus with both the series. And we've seen a really good mix of advisors who are just starting out in their alts journey, which you'd be surprised is a good amount of advisors still. But also those advisors who've been in the trenches with us or been in the trenches with alts for years, and maybe they're still doing it a different way, or maybe they're still doing it a more traditional way with paperwork. And we're able to help educate them and get them up to speed on more of the how of managing these different product sets and managing the partnerships with the asset managers.
That's so cool. I would love actually if we can talk now too about just the CAIS Summit, which like you said, we are so excited to be going to. And so can you just talk a little bit about why you started in the first place, and then what the vision is for this year, and then the most fun thing, which is like, who are some of the people that are going to be there who are speaking?
Yeah. So Matt Brown, our CEO, is the only way to really describe it is a true visionary in our space. The way he thinks, the way he operates, the way he approaches things. He had the concept of the CAIS Summit really to have that one event where we're bringing advisors and wealth managers together in a room and making sure that, you're able to hear about the different topics, the asset classes, specifically the macro trends, the technology trends that are out there in the space. So we started it 3 years ago. And it was, when I explained what it looked like, so I started at CAIS, I think 2 weeks before the first summit.
Oh, wow.
So I started and they were like, hey, have a ticket to come to the summit. I was like, all right, great. And now going into our third year, it's a completely, I would say, different summit, but we've still maintained the core vision, which is to bring the community together, to connect the community, and also make sure people are able to get educated coming out of the event. So essentially what we've done was we built this summit in LA. This year, we should have around 1,200 folks joining us, 600 plus advisors in the room. We have 50 plus asset management partners coming to the event, 30 plus technology partners coming to the event. And the intent of the summit is to educate folks along the lines of the macro trends, the asset class trends, the technology trends, and not only bring people in the room to get up to speed on those topics, but also give them the world to network with each other, talk about business, have conversations around what they're doing or what they're learning from others. And it's blossomed into, I think, the marquee event of our industry. And this year is going to be bigger than ever. I mean, you have everybody from the asset manager side. We have folks like Mark Rohn, who's going to be sitting down for a fireside chat. Todd Bowley, who's big in the industry from both a sports and a media side of things. We have Robert Smith from Vista. We have a full lineup of the top key people within our industry. We have 9 general sessions, 32 case talks. I've mentally tattooed that onto my brain across the board. And it's 2 days in LA in the next 3 weeks. And it's going to be an incredible event. People leave that event and they're pretty blown away by the execution. It's a shout out to the CAIS organization, the marketing team, and just what we're able to execute on across the board.
Oh yeah, when we were talking to a fund manager the other day, they were like, "Who did you have to kill to get an invite to CAIS?" Like, what are you doing with that list? That's awesome.
It's pretty awesome. Yeah, there's so much content that's covered there, where we want to make sure that people are able to make the sessions that they want. So we're very specific with how you're able to customize your agenda to the full capability as an attendee. You're able to get to more wealth-oriented topics versus asset class-oriented topics or macro-oriented topics, and we space it out. I mean, this is a year in the making of just tweaking and tinkering and building. So to see the blueprint laid out and then we take in, execute on that vision has been pretty cool to be a part of. I tell everybody it's the most fun I've had in my career, full stop. And I also tell my team, I say, if you're working in fintech or you're working in financial services and you're working particularly marketing, I mean, there's no cooler thing you could work on than something like this summit to bring the community together.
So for any advisors or managers who aren't involved that want to learn more about CAIS and the CAIS Summit, how can they get in touch with you or reach out to register or what have you?
Yeah, so you can just go to caisgroup.com, check out everything we have to offer. You can see a little bit more information about the summit there. You can fill out a form to have a conversation with one of our product specialists to join the platform. Obviously, you have to go through that conversation and that process to get signed up. But essentially, that's it. We pump out a lot of content on LinkedIn, both from our events as well as just generally.
Yeah, you guys have good educational content on LinkedIn.
Follow
You're definitely worth a follow.
Appreciate that. We're going to be out there for the summit. We have no shortage of partners that will be putting out content while we're there, including yourselves. So we're super excited for everybody coming to LA in October.
Well, we can't wait. Thank you so much, Alex. And we are so excited to be a part of this. And we're so grateful for having you on here and explaining all this. Thank you so much.
Yeah, thank you for having me.